and good morning, and thanks everyone for taking the time to be with us this morning. As Ian mentioned, I'm delighted to be joined with Regina from Robeco and Oliver from BondIT. And a few words about BondIT. And BondIT is a platform that is used for asset manager and wealth manager to optimize their portfolio construction and can spot investment opportunity. I really wish I had this when I was portfolio manager in my previous life. Well, speaking today, what is the topic? As Iran mentioned, it's critical. And I'm going to start with Regina to discuss what happened the last few days and weeks with the 10-year Treasury movement. What does this mean, Regina, for you and for your portfolio?
Great, thank you. We've seen volatility come back in the rates market. The reflation, more U.S. fiscal stimulus, reopening optimism has really driven the global rate sell-off that we've seen year to date. When you look at U.S. growth, that could be the biggest this year in over 35 years. So what we have done is that we were positioned pretty well coming into this sell-off. We had the view that this reflationary and reopening momentum is quite strong, so we have to respect that. So we had steepeners in our portfolios. We are also underweight duration across Europe, the UK, and the US, and also in Japan. At the same time, as value contrarian investors, we didn't really see much value in the credit markets. Yes, some of the fundamentals in the credit markets are improving. Default rates are expected to be still at the relatively low ranges. Earnings are improving from the collapse that we saw last year. But at current levels, particularly in investment grade spreads, we are not being compensated for much risk at all, and the risk and return is not attractive. So for us, we are underweight dollar IG, and also when you look at the US IG market, the duration sensitivity is the highest it's been in decades. So I think that as fixed income investors, you do have to be quite opportunistic and nimble, but also there's still cross-market opportunity. So even though we are underweight duration in many of the developed markets, we are overweight rates exposure in China. We see China rates as a good diversifier. And also, we are being patient to, expect to take advantage in some of the volatility that we're going to continue to see in the rates market and in potentially in FX as well.
Well, thanks, Regina, for this top-down view. You alluded a little bit about what's happening in the spread and in the credit market. Can I turn to you, Oliver, and help us understand how can this impact portfolio construction and what you have seen happening from your side?
Yeah, sure. Thank you for that. And maybe one point, I don't know if you have seen the last edition of The Economist. There was a story about a digital collage sold by Christie's for $69 million. It was one of 3 living artists who managed to sell an artwork at such a high price. Yeah, the artwork was sold as a non-fungible token, NFT, which is a unique digital item. No worries, I don't want to have a lecture on that digital stuff here. Yeah, but this headline news caught my attention due to 2 reasons. Yeah, a never seen amount of money in the market and technology-induced disruption in the financial system. Yeah, and this, of course, has implications to the entire fixed income market, but also on credit spreads. Yeah, and dealing with these implications, this is the basis for new technology. And so also the COVID-19 crisis has already accelerated the need to transform these business models and processes to deal with these challenging macro environments. These events are main drivers of portfolio performance and also for credit spreads. And these technology-based tools like BondIT and Scorable offer enable the assets and wealth managers in both to prepare to ultimately act with these spreads and get confidence when the cycle turns. So this is what we offer to help repositioning the credit and interest rate exposure in an optimal way.
Thank you, Oliver, for this analogy. I like it a lot. Going back to you, Regina, why this time we haven't seen something like a taper tantrum? I understand spread hasn't moved much, and if we go back to the analogy of Oliver was describing earlier, what is your take on this?
Yeah, I think that when we look at the previous rate sell-off experiences, the move in 10-year treasury that we've seen year to date, over 75 basis points in US 10-year, as well as the steepening of the yield curve. Some of the characteristics are similar to the other sort of taper tantrum events like in 2013, or even the bond tantrum event in 2015. I think that when we look at sort of the characters of that spread widening, yeah, there's a little bit more to go in actually where rates are potentially, even the 10-year treasury could go from 1.8 to 2% from here. And in that environment as well, when you look at the growth differentials and expectation that the US will sort of far exceed other regions and countries. The other concern is that also the dollar would strengthen. This could also add more volatility in certain spread markets. So in 2013, like in taper tantrum, you saw EM spreads widen out a bit more than IG and high yield. At the same time, you saw that at that time, the fragile five countries were really, really punished. There's certain things that are a little bit different today. Some of the current account is better in EM. We haven't still seen a very strong dollar strengthening, and also credit spreads and high yield have been essentially flat as a pancake. They've been so resilient. So I think it's early days still, but I think we are positioned in our macro accounts to take advantage if we do see a taper tantrum event. We are, as I said, being patient in adding some credit risk when there is some weakness. But at the moment, spreads are very resilient. But I think that, if we see a little bit more of a steepening of the yield curve, as well as, sort of rise of rates, particularly in the US, then, we would see that filter through in some of the spread risk markets.
Thanks, Regina, for this precision. Another question for you, Oliver. Given what Regina described, and if you look to the asset management industry as a whole business, we know fees are going down, and each basis point is very important to get. And if you look to Europe, Switzerland, Japan, in this negative yield environment, it's become even more crucial to save bips anywhere. Then how we should think about cost of trading when we look at it, and how we should think about using BondIT, for instance, to help generate more bips and save more bips. Can you give us some perspectives there?
Yeah, so I think it's absolutely clear that in that case, technology can help a lot. So the incorporation of it allows the manager to consider the effect of many more variables on their portfolio and suggest alternatives in real time, much better than many people can. And the ability to perform statistical analyses on a technological basis to highlight potential positive or negative characteristics of a portfolio is crucial to outperform the market. What we see is that maybe in the past years, these artificial intelligence-based technologies did not proceed as we expected because of the black box characteristics that we see a lot. So one of our unique features is our explainable AI. So unlike these typical black box models, which only show the input-output relationship, our technology allows users to intuitively understand the rationale behind the analysis and to see which factors drive changes in the risk score. This all helps to scale and create great efficiency for investors.
Thanks, Oliver. I got this part. Let me be a little bit more controversial now. Given what ECB and Fed are doing, they are buying a lot of this bond today in the market. Like the question for you, Regina and Oliver, is why do we still need one credit analyst and system to do it? Like why do we need this? Can you give us some color on your thoughts here? And if you can be concrete, sharing with us some example why we will need them. I'm gonna start by you, Regina.
Yeah, I think that at Rubico, we've actually continued to invest in our analysts and strategists. We've actually hired more credit analysts the past year. Yes, as you've rightly said, we've seen central bank dominance the past decade or so. Many of their actions have driven the risk asset performance and the beta of many markets. But with that backdrop, even after now with COVID and the recovery we are seeing, there are some differentials between the different fiscal stimulus, as well as vaccination and recovery divergences all over the world. So we still think that we view that there are going to be idiosyncratic risks ahead. We just saw volatility in Turkey over the weekend with sort of the push out of the head of the central bank. So you've seen sort of many different risk assets in Turkey significantly widen out. So in our view is that you're going to continue to see these idiosyncratic events globally, and in some of those credit markets, for us as a value contrarian investor, having seasoned, very knowledgeable credit analysts and strategists is for us to be able to pick the winners through the cycle, but also make sure that we're not investing in the losers. So I think that it's a balancing act of sort of having very, very high quality credit analysts, but also continue to invest in technology. So at Rubico, we continue to invest in technology. We have data scientists as well. We make sure that we have the right aggregation and customized visualization portfolio tools. At the same time, sustainable investing continues to be a growing part of many investors' focus. We've launched many SI and climate strategies to meet client needs. And when you want to continue to be an SI leader, like Rubico is, we continue to make sure that we have the right data, the right technology, but also the right people. So I think it's a balancing act of having sort of those three components working together and making sure that we have the best investment process.
I like Regina's balancing act analogy. It's very, very difficult to sustain in this environment. I'm not sure if Oliver will agree or disagree with this one. What are your take, Oliver?
Yeah, I think we all don't know if this time is really different. Yeah, and we should be prepared for the economic cycle not to be a one-way street forever. Yeah, but they will turn, and then it will be unexpected and fast. You need to prepare for that. And an appropriate process evolution bridges the gap from fundamental to automated strategy. And implementation for asset and wealth manager firms is increasingly driven not only by these market developments, but as you mentioned before, by margin pressure and also regulatory complexity. And we have, of course, also another few points that the increasing amount of data needs to be coped with. So to unify proprietary and external data, allowing for construction of bespoke portfolio across numerous custom dimensions is very important. I only give one example, which is the ESG scores that need to be implemented also in a good portfolio construction today, and you need to prepare for that.
So what you're saying, Oliver, is the job of the credit analyst has shifted from not only being quantitative, but being able as well to understand and being able to interpret the data that are available. Then in the old days, the edge of the credit analyst was to get the data. Today is what do you do with the data and how do you implement them?
Exactly correct. So it's not getting the data, it's understanding the data and prioritizing this. And the amount of data is increasing in multiples every year. So it's not possible for every analyst to analyze the data on every given day and every given morning. So to provide the right technology for that, to distinguish between the important and the unimportant stuff every morning is what we are providing, and this is what we are building.
Thank you, Oliver. Going back to you, Regina, then I'm sure your analysts are always pitching you some trade idea and trying to get names I like in the portfolio, and you have your own view as well. Help us understand what is today the most market underpriced trade from your point of view, and the market underestimating this trade, if you can share it with us.
Well, I think right now, as I think, sort of many parts of the credit markets, both in investment grade, IG, are on a value perspective, the risk return is unattractive, and there is not much margin for error. Even 6 months ago, many of our higher beta exposures were in the sort of reopening recovery sectors, so the likes of some of the leisure issuers. But many of those companies have rallied significantly, even energy companies as well. So across our investment grade and high yield strategies, and even our macro strategies, our credit beta is the underweight it's ever been in a very, very long time. In emerging markets, we're essentially neutral beta in the sense that, so the spread differential and the ratios are not as extreme as IG and high yield, but they've also come a long way. And as I said, the risk in a taper tantrum event, EM assets also tend to be punished. So a lot of the sort of price symmetry that we're seeing right now is in rates. So that's why that, most of our risk positioning is actually in the rates market. We do have steepeners across different parts of the curve, and we're just, we're kind of like being a patient credit investor and waiting for, some volatility to come, in the summer or later half of the year to add back risk.
Okay, thanks, Regina. Thanks, Oliver. I don't think we have questions from the audience. I'm going to ask you a couple of questions where I need one-word answer, if you don't mind. This is a surprise. Then let me start by you, Regina. 10-year Treasury by end of year. Can you give me the number? What is your expectation there?
2.
Oliver?
2.25.
Thanks. The other one is, if I give you $1 today, where do you put it? Give me one word. Oliver, start by you.
Rising star potential credit.
Okay.
I would put it in a private tech company.
Okay. Thank you for this. And private question: did you get a vaccine? Yes, no?
Not yet.
Oliver?
I'm in Germany, so no.
Okay. Try to get one whenever it's available. Then Elena, I'm going to hand it back to you. Thank you for this amazing.
Thank you so much.
Thanks, audience, and enjoy the rest of the conference. Thanks, Irene.
Thank you.
Thank you so much, everyone.
Thank
What a
you.
great session.